10-year note bond yields make a big move lower to end the week, today getting below 280 for the first time since late May. And taking a step back, bond yield or 10-year note yields were trading at 347 the day before June FOMC, so a significant move lower since the Fed raised rates 75 basis points, since they continued their quantitative tightening, and since the market had already priced in another 75 basis points hike in July. So the market right now sort of all over the map, a lot of that having to do with weaker data. It started overnight in Europe, it bled into the US, and then we had a very weak ISM number today. GDP now, which kind of gives us a day-to-day look at where expectations are for second quarter GDP, marked at -1% yesterday. So at this point, market right now fearing a recession, and we're seeing treasury yields moving lower pretty fast. Today, the 10-year note yield getting back below 280. Now, what does this all mean for volatility? Well, check out that CVOL index over at cmegroup.com. Typically, we see volatility moving lower when we see yields moving lower, but because of the speed of the move on Friday, because of the fact that we traded so low based on bad news, we actually saw volatility move higher to end the week ahead of a holiday weekend. So volatility moving higher despite the fact that we're seeing yields moving lower as uncertainty and recession fears are creeping into the market. Lastly, what do we have next week? Well, big week next week starts with FOMC minutes from the June FOMC meeting on Wednesday. Looking back over those minutes when they're put out to the market, we typically see busier days on those minutes days than we do on the actual Fed days. And this could be no different given the fact that we have a lot of uncertainty in the market, not only prior to the June FOMC, we want to kind of look and see what they talked about, but since then, a lot of the data has been negative. So it'll be very interesting to see the read that the Fed gives us from those minutes back on June 15th. Likewise, we also get the jobs report on Friday. The jobs report is typically the most important release of the month, becomes a very pivotal number given the fact that if the jobs number comes in weaker than expected, that could also aid and abet here in the Fed not being able to do what they want, and that's normalized policy, something they've been talking about for quite some time. Earlier this week, we heard from Fed Chair Powell talking about concerns for growth. Obviously, those concerns are warranted given the fact that GDP now is marking negative. And we do also have a slew of Fed speakers, but I don't see Mr. Powell on the calendar, at least not yet. So clearly, with the markets trading the way they are, he may get a special scheduled session, but we do not have anything from him at this point. So 10-year note yields ending the week lower, pushing below 280 for the first time since late May, ahead of next week's FOMC minutes and the jobs numbers.